Great. We are so excited to be here with Steve Nance with Drill Down Solution. This is one of our newer partners in the partner program here at Dentist Advisors. Steve's a CPA. We're going to talk about their business model, and how well they work with dentists inside this industry. And Steve, excited for you to share your deck with us, and I'm going to turn the time right over to you, and we'll chime in here and there as we have some questions.
Okay. Well, sounds great. Thank you, Spencer, for letting me be part of the Dentist Advisors community and sharing a little bit about Drill Down Solution. So I want to start by first introducing our firm here. This is a picture of our team. This is a couple years ago, but for the most part, it's the same people that we still have today. We have a great team of tax professionals and a really fantastic team of bookkeepers. And then we have got a great admin support that help us do everything that we need to do. So I want to share just a little bit of history about our firm. So our firm started in 2004 under the name Lunsford Peck CPAs. And it was a traditional accounting firm, not necessarily dental specific at the time, but over the years, the firm had acquired a fair amount of dental clients. And the founders of our firm realized an opportunity, and they created a spin-off company that started as a dental consulting firm that developed some dashboards and analytics and turned that into a software now known as Dental Intelligence, which is now the leading dental analytics software company that's out there. So it's really cool to see where they've come. When I started with the firm 11 years ago, it was the accounting firm and dental intel, kind of one and the same, sharing the same space. And there were maybe 5 employees of dental intel at the time. So it's really cool to see. Now, after the spinoff, we continued our general CPA services, some dental clients, some non-dental. And we got involved with an accounting consulting group, and we realized at one point that we needed to have a niche. And dental was the natural fit because of our background. And I always liked working with dentists, so I was excited by that prospect. Dentists have a lot of unique opportunities. I don't know of a better profession where someone can make such a great income and have such a great work-life balance. It's really great for that, although it's not easy for everyone. And there's a lot of unique challenges that I'll touch on a little bit later, but it creates a lot of opportunities for us. So we decided to go all in on that dental focus. We rebranded, we changed our name to Drill Down Solution, and that's right at the time I bought into ownership of the firm. So it was a lot happening all at once. In retrospect, it was good and bad, but I'm glad we did it. And it's put us in a great spot going forward. So this is my family. I'm married. I have 4 kids and a little dog, and I love the outdoors. I'm a skier, I'm a runner, and I love to get in the water as much as I can. I don't own a boat, but if you own a boat, you're my friend.
Yes.
So that's just a little bit about me. Our mission at Drill Down is to increase our clients' financial position proactively, utilizing authentic and innovative tax, accounting, and consulting solutions. So that's what we do. On the bookkeeping side, we provide the standard reports, the profit and loss, balance sheet, and supporting detail every month. But one thing we've realized is most dental practice owners don't really know what to look for when they see that package come every month. They might look at bottom line net income and feel great. Okay, I'm positive, I'm profitable. Or if they spend a lot of time, they can drill into the detail. But we've evolved this over the past couple of years or so, but we started including a benchmark summary with our monthly reports that we send out. And so this, as you can see, we're we're showing some standardized benchmarks. Now you can argue about what those standards need to be and what the exact averages are. You could go back and forth, but this at least gives you some kind of industry standard to see where you're stacking up. And then what's I think valuable is just looking at yourself and the trends and where you're going and comparing this from month to month. But we're also showing EBITDA, which is a hot item in dental right now. Most dental valuations now are based on some calculation or some form of EBITDA. And then cash flow, which as you can see, and this is, by the way, a real example of one of our clients. I redacted the name, but you can see that cash flow is very different than net income. And in this example, it's substantially less. They're losing money, even though they've been showing a profit the last year and the last 6 months. They're actually losing money during that same time in the practice. And there's a couple reasons for that. One is there's debt, and the practice is paying down debt. And that obviously takes cash to do so, but it doesn't come off of the bottom line net income. That's just a cash transaction only, outside of the interest income that is going to be, or interest expense that is going to be in the P&L. And then the other reason is distributions. The owner's taking distributions, and of course there's nothing wrong with that, but you just need to know that cash flow and net income is not the same thing, and kind of have an understanding of that. So this kind of gives a snapshot summary of some highlights that make the financial statements useful.
Mhm.
Now, when we talk about tax planning, there's really 3 areas that we focus on. One is compliance. We want to make sure our clients get their tax returns filed on time, pay the taxes that they owe, avoid penalties when they can, and avoid, jail time or other serious repercussions that can come from not being compliant. And the second is that we want to help our clients budget for taxes that they owe. If a client is going to owe a big amount of tax, it's going to be due on April 15th. You don't want to find out that you owe that tax on April 10th. You want to have plenty of time. We want to have ideally several months where the client has a ballpark good close estimate of what that amount is going to be before we even prepare the tax return. And then we want to minimize, or at least provide the information so that our clients can know what they can do to pay the least amount of taxes legally possible. And our clients are a bit of a mixed bag. I've got some clients that they want to be aggressive. If there's a legal strategy to lower taxes, they want to do it. And there's probably some that if we let them do illegal strategies, they'd do it too. And then of course there's more conservative, where we might bring up several strategies that can save them a lot of money. But understanding that there could be risk that the IRS is going to challenge, because the IRS can be aggressive too. They can challenge legal strategies if there's a lot of taxes at stake. And so sometimes those kinds of issues aren't resolved until you get to tax court. And if there's any kind of risk like that, or any risk of penalties or a reassessment by the IRS, there's clients that don't want to go there, and I can respect that, but I do want to get those clients the information so that they can make an educated choice. And they usually appreciate that too. They want the information, and then they can make an educated choice. I want to show this example that the tax code actually inadvertently discriminates against dentists. And I'll show you in this example. This is obviously a fictitious example, but Dr. Smith, a dentist, if he earns a W-2 wage in 2023 of $170,000 from his S corp plus a profit of $830,000, that's $1 million of total income. And if this dentist is using $200,000 of that income to pay down debt, there's about $800,000 left for cash flow or available take-home pay. Now, if you compare that to a non-dentist that doesn't have the same debt, Salesman Dan earns a W-2 wage of $290,000 plus an S corp profit of $710,000 with no debt to pay down. there's the same total $1 million of starting gross income.
Mhm.
Both file married filing jointly and take the standard deduction. In the dentist example, the dentist starts with $1 million. They take their standard deduction. They're left with taxable income of $972,300, and they pay a total federal tax bill of $289,666.
Hmm.
Compare that to salesman Dan. Starts with gross income of $1 million, same starting point. But then there's this sneaky little thing called the qualified business income deduction. This is not available to dentists if they're making more than about, in 2025, it's about 485,000.
Mhm.
If their income is beyond that, they don't get this deduction. But all other business owners, well, certain industries, dental being one of them, medical, accounting is actually one of those excluded professions too. But if you're not in one of those identified industries, every other business owner gets this deduction with some complicated calculations. I don't want to necessarily get into all the detail,
Mhm.
but the dentist doesn't get that. Others do. They get the standard deduction just like the dentist. They've got taxable income of 830,000 and some change. They pay a total federal tax bill of 237,125. So if you compare that, the dentist who had 200,000 less of available take-home pay ends up paying 52,000 and some change more in taxes. So when you compare the cash flow, that leaves the dentist with $250,000 less in cash flow that the non-dentist has. So that creates some issues. Now, to be fair, the dentist probably got some tax benefits when they incurred the debt. Take Section 179 for equipment purchases and things like that. But we generally want to take as much tax deductions as we can up front to take those benefits, but then you're still paying the debt service payments for years down the road, which creates a timing issue, which creates a lot of complications for taxes down the road. So
Mhm.
it's not uncommon for a dentist to be scratching his head wondering, why am I paying so much in taxes when it doesn't seem like I'm making that much money? Well, this is a prime example. The debt really makes that an issue. Now, risk mitigation. A lot of people ask me, how do I avoid an audit, or how can I prepare for an audit, or how can I avoid penalties? We want to help our clients pay less in taxes, um, but pay the taxes that you have to pay, right? But we don't want you to have to pay any penalties. So these are just a few tidbits. File your taxes on time or by the extension deadline. A lot of people ask, is there a strategy to file an extension? And generally there isn't. There may be some cases where we need to do a defined benefit accrual, and we need some actuarial calculations, and we're waiting on those, or we're waiting on K1s from other sources, and we have to file an extension because we don't have all that information. But generally, you want to file your taxes on time if you can, because one, that finalizes the taxes. You're not relying on an estimate anymore, and you can pay the taxes you owe and move on. And two, that tax return from the prior year really becomes a baseline that's used for planning for the next year. So we can get a lot closer and more detailed in our projections and estimates if the prior year is done and behind us, and use that information for comparison.
Hmm.
The other one is pay taxes on time. So not everyone realizes this, but you can extend the time to file, but you can't extend the time to pay. Taxes are due April 15th. If you don't pay by then, you're going to have to pay a penalty. So pay, if you have to file an extension, at least pay an estimate in, and if anything, pay a little bit more than expected. And so that
Hmm.
you could use that estimate, that excess, either to apply toward next year's estimates or get a refund, but you can avoid penalties.
Right.
Report all your income. Um, if you don't report all your income, the statute of limitations for the IRS to come audit you and to reassess additional taxes could be extended. And in some cases, it could even be unlimited. And so we don't want that. We want to start a clock where the IRS can't audit you. and have that be as limited as possible. And also the penalties can be much more severe if you leave off income. So if you're getting paid in cash or anything else, make sure you report all your income. Have good, clean bookkeeping. When we do tax planning, we're typically relying on the bookkeeping. Sometimes we do our own internal bookkeeping, and that's great. But if the client is doing their own bookkeeping, and that bookkeeping is, there's a lot of personal stuff mixed in, or not everything's deductible in the expenses, that can really throw off the planning. And then come time when we actually are finalizing the tax returns and have to make some adjustments, they could end up owing a vastly different tax amount than what was projected previously. So we want to avoid that as much as possible. Keep receipts. Now, I don't need my clients' receipts, but the owner dentists, they need to keep those receipts in case they ever are pulled for audit. Fortunately, there's a lot of electronic apps nowadays that you can store those electronically. You don't have to keep all these physical receipts. But I was involved in an audit several years ago, and this was not a dental client, but a client did get audited, and shortly before they got pulled for audit, they had an armed burglary, and the burglar stole all their financial records.
Wow.
She had kept receipts, but they got stolen. And when we told the IRS that, well, they didn't have any receipts to prove it, even though we showed a clip of the news article, and we might have even had some actual court legal documentation. The IRS didn't have those receipts, and that was an issue. And this was several years ago. I think everything ended up getting worked out in some form or another in the appeals, but we had to go to appeals to get the IRS to care. Without those receipts, they didn't care. So you just, I mean, in this case, she did everything possible, but just know how serious it is that you've got to have receipts. And in most cases, a bank statement and a credit card statement does not count as receipts. So keep those receipts in case you are pulled for audit. If you do participate in an aggressive or high risk tax strategy, when I say aggressive or high risk, I don't mean illegal, obviously, just something that we know has the potential for the IRS to challenge. And we're going to communicate the tax savings associated with that. I'd say invest those tax savings in something that can be liquidated if you are pulled for audit. And that's where dentist advisors could come in and help clients know where to put that money.
Yes.
Planning and budgeting. I think it's good advice to get your tax estimate and your tax planning finalized by December 1st. And that leaves some time to execute on whatever strategies you need to execute on generally. And it also gives plenty of time for budgeting for that. And then, I mean, most people want to enjoy Christmas and not worry about tax planning. So we don't want to be doing tax planning December 23rd, although we always still are. but generally, you want to have that done and buttoned up as soon as possible so there's time to execute. Save the tax estimate if you know you're going to owe on April 15th. Save that money. You don't necessarily need to prepay it all. You need to make your required prepayments, but outside of that, put that in something that can generate a little bit of return and can be liquidated by April 15th. And again, dentist advisors can help people know where to put that. Get your tax returns prepared early. I touched on this early, or that once your tax returns are done, that just creates more time and a baseline for planning for the next year. So if you can, let's get it done early.
Yep.
Here's a list of common tax strategies that we work with on the business side. So I'm not gonna go into detail on every single one of these, but structure is very important. We want to have generally an S corp is the optimal structure for a dental practice, and there's reasons for that. In some limited cases, it may not be the best structure. And then for other things like real estate, you don't want an S corp at all owning your real estate. So we want to make sure we're setting people up in the most optimal way possible. And here's some retirement strategies. And again, this is great when we work with someone like Dentist Advisors in tandem. And it's great when I'm on the call with the client and someone from Dentist Advisors, and we're strategizing together with the client. The client is getting great service when we're talking about this all together. And I've listed these retirement strategies somewhat in a strategic order. IRA is a great place to start for some qualified funds. You don't need to worry about setting up a plan for your practice or worrying about employees. It's just for yourself. It's individual retirement account. You can also do it for your spouse. So between a taxpayer and a spouse, you can put away $14,000 a year. You have until April 15th of the year following, and it counts as the previous year tax deduction. And that's a great place to start. That's not going to move the needle hugely if you're high income. So that's where setting up a 401k and some of these more bigger plans can be more useful. At the bottom, I've listed the cash balance defined benefit plan. That's what I consider as kind of the landmark retirement plan that can have the most optimal current year tax benefits. Most of our clients who do a cash balance defined benefit plan are able to put well over $100,000 a year into their retirement plan, completely tax deductible. It's based off of an actuarial calculation. So as opposed to the 401k that has predetermined IRS limits, the cash balance defined benefit plan, you're targeting a benefit. And so actuaries calculate what you can do each year. They work really great for the folks who are 50 or better, and are kind of getting closer to that retirement age, but are not necessarily ready to retire. So those are the ones who we see who can really stack away a lot into one of these plans. These are some personal tax strategies. Again, we don't have time to go in great depth to all of these, but some common strategies that we employ that is part of that tax planning discussion. So what we do when we do tax planning is we'll do a projection first, see where you're at, kind of what's the worst case scenario. Here's the taxes that you owe if you don't do anything. And then based on where that projection comes in, we handpick and tailor these strategies that are a good fit for where you're at. And then we come up with a game plan. We give the clients a roadmap, and in some cases introduce third parties to help execute on some of these plans. But that's how we approach it. And then there's some other advanced tax planning strategies that I'll just kind of hit on. An accounting method change. So when we account for your income in your dental practice or your business, that's typically either on a cash basis or an accrual basis. Typically, we want to be on a cash basis, because what a cash basis is saying is we recognize income for tax purposes when it actually hits the bank account, when you actually get paid in cash. So your collections. Accrual, you're paying taxes on your production, even if you haven't collected that money yet. So generally cash is better, but the advantage that accrual might have is that you get to also accrue your expenses when they're incurred, even if you haven't paid for them yet. So it could be a timing difference. You can change your accounting method, and sometimes it's worth having a look-see at your accounting method and seeing if it would be optimal to change. Pass-through entity tax elections. If you live in a state that has an income tax, I live in Utah, we have an income tax. There are a handful of states that don't have an income tax, but of those who do, pretty much all of them have this pass-through entity tax election. What it is as a business owner, you can elect to pay your state income taxes at the business level instead of at the personal level. And what that does is it creates a business expense that would otherwise be a personal expense, and business expenses are tax deductible. So if you live in a state with an income tax, you should be doing this as much as possible. Now, a lot of these elections expire at the end of this year, and we'll see what happens with state and federal tax changes this year. There could be a lot, but definitely if you haven't done this, make sure you do it this year. and R&D tax credit. So just to kind of high level summarize for those who aren't aware of the R&D tax credit, it's a dollar for dollar tax credit. It reduces taxes dollar for dollar, and it's based on innovation. And that doesn't need to be innovation for the world. It's innovation in your business. So it's common in dental practices where they buy a new piece of equipment. It could be a milling machine or something that, or a 3D printer. And they've got to spend some time learning how to use that, and not just learning, but experimenting. And with the ultimate goal of adding something new or improved to their business. It's also common for general dentists to add specialties, and it takes some time learning and maybe some trial and error, maybe some experimenting and trying out on test cases before they're actually seeing paying patients. I've seen that before. So that kind of thing can go into an R&D tax credit. The actual calculation is complex. We won't get into it here, but it can be very useful. And if you own your building, it may be optimal to get a cost segregation study. So what this is a third party will come in, do a study on your building, and break out the costs of that building that are not just the raw structure of the building, but things like appliances, fixtures. Those kinds of things can be depreciated at a faster rate. So instead of spreading your depreciation out over 39 years where you get very little benefit per year, you can get some of those tax benefits up front, and that can maybe move the needle a little bit more than spreading it out over 39 years.
Yeah.
There could be some state tax credits depending on the state you live in. Captive insurance. The idea with captive insurance is you're setting up an insurance company to insure your business. So it's common in dental to use one of these strategies for recare or to insure against unknowns like political risks or another pandemic that can be unforeseen. And because it's insuring your business as a whole, you can justify paying a high premium. And really, you're just taking money from one hand into another. You own the insurance company. And there are some fees for administration, but for the vast majority, you're just moving hands in this exchange, and it's completely tax deductible. Now, when you have excess, it's not all used for claims, but you want to pull that money back out for yourself, you can do that because you own the insurance company. And you do pay some taxes when you pull the money out, but you're taxed at a lower rate. So you can benefit by getting a high tax deduction now and then benefit from the time value of money and pay a lower tax rate later. So now bear in mind, this is one that the IRS does like to challenge. So we want to make sure we're legitimate in everything. We use a third party that manages it. 1031 exchange, if you own real estate and you want to continue to own real estate, but want to maybe get rid of the one you own, that could be a useful way to defer gain and grow your wealth. Opportunity zones, this is another one that's set to expire at the end of this year, but we'll see what happens with tax law changes. But the idea with an opportunity zone is if you, in a capital gain year, I know we're running short on time, but you can invest into an opportunity zone fund. And what this is typically a fund that owns real estate or some other type of investment property located in areas by the government as areas that they're trying to revitalize. And it defers the gain until tax year 2026. So you pay taxes April 15th of 2027. So you can benefit on having a longer time frame to pay your taxes. And then the long-term benefit is if you hold on to that opportunity zone investment for 10 years or longer and it appreciates more, and then you want to sell out and get rid of it, you don't pay any additional taxes on the additional appreciation. So that could be a good long-term benefit.
Yeah. Equipment
leasing, there's some strategies about buying a bunch of equipment, creating a business out of it, leveraging it with debt and getting some upfront tax depreciation on things like that. I know, are we doing okay on time, or do we need to wrap this up?
No, let's keep going. This is great.
Okay. So I just wanted to share a couple of case studies. This is from a client that was new to us in 2019. This was our tax planning that we did. We had him do a captive insurance premium of $100,000. So again, he's saving that $100,000 into another account basically and creating a new entity by doing that. Also had him do a conservation easement. Now the laws have changed around conservation easements. They're really not as optimal of doing anymore. But those two strategies brought him tax savings of $156,000 and some change. And then the other kicker with this is the estimates that were required to pay for the next year. The quarterly estimates that you're required are based off of the prior year. So if you drive your tax down now, you're really creating a longer time frame that you have to pay next year's taxes too, which creates more opportunity to strategize and plan for the next year and have more money to invest or to execute on the next year. So that really was a great opportunity for him. Now, a study more recently, this was a tax plan. I mentioned that we give our clients a roadmap. This is essentially word for word from the roadmap that we gave. Told them to make this PTE state tax payment of about $25,000 by the end of the year. Put some equipment into service. We adjusted the spouse's wage, did some 401k contributions, and then some retirement savings. Oh yeah, the IRA, the 401k just allows more contributions than a simple IRA. So the tax savings from this tax strategy was $51,000 and some change, and this was projected numbers. We haven't finalized the tax year yet, but this is just kind of a typical strategy map that we give our clients. I had one that was over $1 million this past year, and he ended up not doing everything, but this is common to save 50,000 or so. Of course, there might be some less, but there's some more as well. So this is just kind of what that roadmap looks like of here's a few things that you need to do, when you need to do them, here's the expected tax savings. And then we can get into long-term planning. I want to understand my client's goals. A lot of times we can focus on the current tax year or even the past tax year, but understanding the goals can really affect how we do things because we want to kind of look at the long term as well. So that's where, again, working with someone like Dentist Advisors can be very beneficial when we're looking at the retirement planning and the estate planning along with that. So here's my contact information. I kind of breezed over a lot of things, and there's a lot of strategies that we employ, but I'd love to answer questions about any of those strategies or anything that we've talked about if you want some more details. Thank you.
Steve, so good. And the strategies towards the end there, those are just ones that not everyone thinks about all the time or are well enough educated or up to date on some of them that it's so useful to have you in our corner to be able to not only suggest, but to look it over and to make the recommendations. What an awesome presentation. And we're really looking forward to some of our additional content that we'll be doing with Drill Down Solution on our webinar series and our monthly newsletters and so on and so forth. You can see Steve and his team and get to know their business on dentistadvisors.com, and really looking forward to working with you guys.
Well, thanks so much, Spencer. Appreciate it.
Thanks so much, Steve. Talk soon.